We have talked about employee and employer contributions. What other considerations go into a properly designed 401k plan? Let's talk about eligibility. As you know, employees come and go. The IRS allows for an eligibility period before employees may start contributing into the plan and receive employer contributions. You may set an eligibility for a period not to exceed 1 year, an hour requirement not to exceed 1,000 hours, with an age requirement of no greater than 21. You can craft eligibility criteria that meets your company's philosophy and competitive environment. Additionally, good plan design will consider how many entry dates to have into the plan. Once a person satisfies eligibility, they will enter the plan on a specific entry date. You may have entry dates as infrequently as semi-annual, or they can be quarterly, monthly, or as frequent as on each employee's date of hire. As a practical matter, usually fewer and systematic entry dates makes it easier for your HR department and ensures that you do not miss enrolling a participant once they become eligible. Let's do an example. Assume that you have a 6-month waiting period with quarterly entry dates. If a participant was hired on March 15th, 2017, 6 months later, they will have completed their eligibility period on September 15th, 2017. Their entry date would be October 1, 2017. Eligibility and entry dates are important concept decisions in designing your plan. You must balance the cost of allowing employees into a plan right away versus having them wait for a specific period of time. Generally, the more liberal the eligibility criteria, the greater cost of employer contributions in the plan. The last eligibility concept is something utilized frequently in retirement plan design. This feature is called the last day of service clause. Essentially, this means an employee must be employed on the last day of the plan year to receive the employer matching or profit-sharing contributions. This feature can often save your company, depending upon its size, thousands of dollars each year, which helps mitigate the cost of employee turnover. Let's shift gears to a concept called vesting. Vesting applies to all non-safe harbor contributions. Essentially, the term vesting means that once a participant has worked a certain number of years, they are entitled to all of the employer contributions. Decades ago, vesting schedules could be as long as 10 years or more. Now, the longest vesting period cannot exceed 6 years. Each year a participant works 1,000 hours, they receive a year of service for vesting. The most common vesting schedules are the 6-year graded vesting schedule or the 3-year cliff vesting schedule. You may also design a vesting schedule that is more liberal than either of the two allowed by the IRS. The last concept to discuss for a properly designed plan is distributions. In general, all retirement plans allow employees to receive distributions on account of death, disability, retirement, or termination of employment. There are, however, other types of distributions that an employer may allow. The most common type of distribution is called a hardship distribution. This is strictly defined by the IRS to be one of 6 factors, as shown on this list. Hardships may be allowed for either employee contributions, employer contributions, or both. Hardship distributions are subject to income tax, and the IRS 10% premature withdrawal penalty, if a participant is under age 59.5, applies, and there is a 6-month prohibition which prevents employees from making employee contributions from the date of taking a hardship distribution. One other popular distribution option is participant loans. Unlike a hardship distribution, which is subject to tax and penalties, there is no tax or penalty on participant loans. As always, there are few rules. A participant may borrow the lesser of $50,000 or 50% of their vested account balance. Employees must repay the loan within a 5-year period unless they are purchasing their primary residence. Participants must pay a reasonable rate of interest based upon market conditions. The plan document will set the participant interest, usually at prime plus 1%. The advantage of the participant loan? No taxes are paid, and the participant repays their loan into their account along with nominal interest. So we've covered all of the major features regarding 401k plan design. As a plan sponsor, it is important to know that all provisions may be changed. As your company grows or changes, the plan may change as well. You will find that a properly designed 401k plan can truly be one of the greatest benefits you can provide for your employees. Let the professionals at PPA help you design a custom plan for your company. In the end, it's all about plan design.